Let me ask you something real quick. Have you ever spent days analyzing a chart, building the perfect trade setup, entered with confidence, only to get kicked out of your funded account because of a rule you barely understood? If you're a swing trader trying to get funded through a prop firm, I need you to watch this entire video, because what I'm about to share could save you hundreds, maybe thousands of dollars. We're going to break down exactly why most prop firms are not designed for swing traders. And then I'm going to show you something specific that just happened with FundedNext, one of the most popular prop firms out there that every swing trader needs to know about before they spend another dollar on a challenge. Before we get into it, let's quickly make sure we're all on the same page. Swing trading is a trading style where you hold positions for multiple days, sometimes even weeks, to capture what we call a swing in the market. You're not trying to scalp 10 pips in 5 minutes. You're reading the market on the 4, hour, the daily, maybe even the weekly chart. You're waiting for structure, confirmation, and then you let the trade run. It's a patient game. It's a disciplined game. And quite frankly, for a lot of people, it's a profitable game when left alone. The problem? Prop firms were not built with swing traders in mind. They were built for day traders and scalpers. And the rules reflect exactly that. Let me show you why. Let's talk about the structure of your average prop firm challenge. The daily drawdown limit. Most prop firms enforce a daily drawdown, typically 4% to 5% of your account balance per day. Sounds simple, right? But here's where it gets dangerous for swing traders. There are two types of drawdown calculations, balance-based and equity-based. With balance-based drawdown, only your closed losses count. Nice and predictable. But many firms use equity-based drawdown, meaning even the floating, unrealized loss on your open trade counts against your limit. So imagine this. You're a swing trader. You enter a solid setup on your USD Monday morning. By Wednesday, the market dips against you temporarily. Not enough to hit your stop, but enough to put your equity down 4.5%. Account blown, trade over. The market could reverse Thursday and hit your original target perfectly. But you're already done. You already failed the challenge. That is not a trading problem. That is a rules problem. And it's a problem that was designed around day traders who close their positions every single day, not swing traders who hold through normal market fluctuation. The time limit. Most challenges give you 30 days to hit an 8-10% profit target. For a scalper, hitting 20 trades a day, 30 days is plenty. For a swing trader waiting for high-quality setups that take 5, 7, 10 days to play out, you might only get 3 or 4 real opportunities in that window. Miss one, and you're behind the curve? Panic trading to catch up. This entire structure was designed for speed. Swing trading is designed for patience. They are fundamentally at odds. Now let's talk about the one rule that I think is the most damaging to swing traders specifically, and it's the one that most people don't read carefully enough before they sign up. The no weekend holding rule. Think about this from a swing trader's perspective. You open a trade on Thursday. The setup is clean. Your target is 200 pips away. Your stop is tight. Everything is perfect. But the trade hasn't played out yet. You need the weekend to pass, and Monday's open to complete the move. In a personal trading account, no problem. You hold the trade, go enjoy your weekend, and come back Monday to either manage or close it. In many prop firm funded accounts, you can't. Your position gets automatically closed before the weekend, whether you like it or not. And this is not just a policy with some small, unknown firm. Let me talk specifically about FundedNext, because they are one of the biggest names in the prop firm space. Here's what you need to know. FundedNext has two different sides to their business, their CFD, Forex side, and their futures side. And the rules are very different. On the futures side, FundedNext does not allow overnight or weekend holding at all. All positions must be closed by 3:10 p.m. Central Time every single trading day. If you don't close manually, the system closes them for you automatically. But even on the CFD side, once you pass the challenge and get into a live funded account, which is the whole point of doing this weekend holding, is not permitted. You can hold over the weekend during the challenge phase, but the moment you're actually funded, that privilege disappears. Read that again during the challenge, they let you hold over the weekend. But once you're actually funded with their money, the rules tighten. All positions must be closed before market closure. If a rollover exceeds 2 hours, your trades are auto-closed. This is a massive issue for swing traders, because the entire reason you're working toward a funded account is to trade your actual strategy. If your strategy requires holding positions over the weekend, and for most swing traders it does, then you've just been handed a funded account that you can't actually use the way you trade. Think about how many major setups happen going into the weekend. Think about how many swing trade entries are triggered Friday afternoon, with targets on Monday or Tuesday. Think about how currency pairs gap on Sunday's open, often in the direction of your trade. Prop firms protect themselves from weekend gap risk by forcing you to close, but in doing so, They completely eliminate your ability to trade like a swing trader. And while we're talking about holding restrictions, let's add another one to the list because it gets worse. Many prop firms do not allow you to hold trades during high-impact news events. We're talking about NFP, non-farm payrolls, CPI releases, FOMC decisions, interest rate announcements, the exact moments where the market makes its biggest, most decisive moves. Some firms will automatically close your positions minutes before a scheduled news event. Others will flag your account or even disqualify your results if they detect you held through one. Now, think about what this means for a swing trader. You entered a trade on Monday, it's been running perfectly for 3 days. Friday comes, NFP drops, and instead of letting the fundamental catalyst push your trade to target, the system closes you out beforehand. You don't get the move. You might not even get your profit. For swing traders, news events are often the confirmation of a directional bias they've been building all week. Taking away the ability to hold through that moment doesn't just limit your strategy, it rips the engine right out of it. These firms want the appearance of your profit without bearing any of the real market risk. And once again, it's the swing trader who pays the price. Let me make this real with some numbers. Let's say you're swing trading a $100,000 funded account. You risk 1% per trade, that's $1,000 per setup. Your average trade takes 4 days to play out. Your average reward to risk is 3 to 1. In a perfect environment, that's a beautiful, sustainable strategy. Now add Propfirm rules. Your daily drawdown is 5%, that's $5,000. Sounds like enough room, right? But you're holding trades through normal retracements of 1.52%. On an equity-based drawdown, that 2% retracement on a $100K account is $2,000 of floating loss. Already 40% of your daily limit eaten up by a trade that is completely fine and on track. Add one more small position moving against you, and suddenly you're close to the breach line, all while being in valid, well-structured trades that simply haven't reached target yet. And the worst part? If the market closes for the weekend while you're in those trades, in many accounts, those positions are gone. You don't get to see if you were right. The firm just closes you out and you miss the move. That's not trading. That's gambling with rules stacked against you. Now, to be fair, let's understand why prop firms have these rules. Because it's not entirely without reason. Prop firms are in the business of risk management. They're giving you access to capital, and they need to protect that capital. Over the weekend, markets can gap, news can break, a currency can collapse, a war can start. If you're holding a $100,000 position over the weekend and it gaps 300 pips against you when the market opens Sunday, that's their problem too. So, from a business standpoint, no weekend holding rules make sense for them. The problem is that it's sold to traders as a path to fund their trading strategy, when in reality, the rules actively prevent certain styles from functioning. If you're a swing trader and you sign up for a prop firm challenge without reading these rules carefully, you will inevitably find yourself in one of two situations. Either you change your trading style to fit the rules, which usually destroys your edge, or you keep trading your strategy and you get kicked out. Neither outcome is good. Here's my final word on this. Prop firms are a business. They're not your partner. They're not your coach. They're a service. And like any service, you need to understand what you're actually buying before you hand over your money. For scalpers and day traders, many prop firms can genuinely be a great vehicle to access capital. But for swing traders, the rules, the drawdown calculations, the no weekend holding policies, they are structural mismatches. Trade your strategy, not their rules. If this video helped you, drop a comment below, tell me if you've been caught by any of these rules before. And if you know another swing trader grinding prop firm challenges without knowing this stuff, share this video with them right now. It might save them a lot of money. See you in the next one.